Hey friends, Charlie Jewett with the Renovating Retirement Podcast and also JewettWealth.com, Jewett wealth.com. I wanted to show you something from 2013 that's actually still very apropos today, which is that people believe, and the joker brokers tell you all the time, that the market is trending up and it's a great time to be in the market, and that this growth we've had since 2008 is indicative of kind of what you can expect. And the reality couldn't be any further from the truth. It's wonderful if you've been in the market and you've experienced these gains, but you need to choose for yourself based on what I'm going to show you if you think it's safe to stay there. So here on the screen, we're kind of seeing a picture of the gains from 2008 to 2013, and it's gone up even further since then. It's just going bam, going up, right? But why is it going up? Well, take a look at the next slide. So here we have during these times where the government was buying bonds and mortgages. So they're falsely supporting the stock market. So the government is doing this. They've got this one, this one. These are the times when they're either announcing that they're going to continue quantitative easing, or when the quantitative easing is actually happening. If you want to understand quantitative easing, you can go study it, but really it's just sort of falsely supporting the economy to keep up with inflation. You're basically buying stuff from themselves, which is just kind of silly. But look at what happens during the times where they're talking about taking quantitative easing away, or when they're actually not purchasing anything. What do we see? It's very subtle. This would be kind of easy to miss, but what are we seeing? It's that when they don't do this, when they don't falsely support the economy, what happens to the stock market? It goes sideways or it goes down. So they're not going to do this forever. They're not promising they're going to do this forever, and they probably can't even do this forever. So this was in 2013. It was already looking really, really bleak when we were well past the average length of a bull market. That's when the market goes up for a long period of time. Now, how far past it are we? We're about 87 months into a bull market when the average is only about 47 months. Look at this run up, people. This is ridiculous. Let me get a color here. Oh, that's fine. Look at this run up. We had these hiccups. We hit the ceilings here. Bam, we broke through. Here's a little hiccup in January. This is really, really, really high. So 87 months into a bull market, when the average is 47 months, and with this much growth, and most of it coming, if not all of it, coming from quantitative easing that they could take away at any time, I would say it's a really good time to look at saying thank you to the market, thank you for the timing, whether it was on purpose or not, and then protecting your money in other strategies that cannot go backwards ever. That would be indexed annuities, indexed life insurance, or possibly just leaving your joker broker and going to a better money manager, somebody who can show a track record of beating the S&P 500, or someone who has not lost money, didn't lose money in 2008, and can protect this for you. Hope that's helpful for you. Charlie Jewett with the Renovating Retirement Podcast, and also JewettWealth.com, Jewett wealth.com. And if you found this video, you probably already know this, but www.meritvideos.com, MERITVIDEOS.com. Talk to you soon. Bye-bye.